Finimizers, welcome to another Finimize live event. I'm Stefan, I'm an analyst here at Finimize, and I'm extremely happy to host today's event on the US election, the landscape, regardless of who wins, with our partner, Charles Schwab. So first, we have some basic housekeeping rules to run through. First, as you're coming in, please just fill out the poll so we can get to know you a bit better. Feel free to introduce yourself in the chat. Please don't tell us if you're happy with the election results, but please do tell us where you're tuning in from. And remember to switch to all attendees so everyone can see your messages. In terms of format, it's going to be a 15-minute discussion followed by a 15-minute audience Q&A. So please use the Q&A box to ask a question. And if you see a question you like, upvote it so it moves to the top. And that way we can get through the most upvoted questions first. Okay, so let's kick this off. I'm very, very thrilled that we've partnered with Charles Schwab today. They believe in the power of investing to help individuals create a better tomorrow. They have a history of challenging the status quo in their industry, innovating in ways that benefit investors and the advisors and the employers who serve them, and championing their clients' goal with passion and integrity. And joining me today are two really big heavyweights from Charles Schwab, Richard Flynn, Managing Director and Chief Executive of Charles Schwab Retail Business in the UK, and Jeff Kleintop, Chief Global Investment Strategist. And you might want to pay very close attention to what they say, because Richard brings over 20 years of expertise in equity markets, specializing not just in US investing, but also in delivering financial advice to an audience just like you. As for Jeff, well, the Wall Street Journal has named him one of Wall Street's best and brightest. So, that probably explains why he's such a powerhouse on global markets, and probably why you've seen him in top medias like the Wall Street Journal and CNBC. So I think it's fair to say today, you're in very good hands. Richard and Jeff, great to have you here. How are you both doing today?
Great to be here. Thanks, Stefan.
Doing great.
Awesome. So, Finimizers, let's dive in. And let's start with you, Richard. So, there's a lot of election buzz in the air right now, but as a long-term investor, should I even care? I mean, political changes, do they really matter for long-term investors, or is it just noise at the end of the day?
Well, there's certainly a lot of noise. And I think I'll start with a very obvious statement, Stefan, which is that elections are very emotional. This week has been very emotional in the run up to it and subsequently, and that's not unusual. And they're emotional to us for a number of reasons, but principally it's because we live in democratic societies, and it underlines the role that we play as individuals, so that the social contract that binds us together. And it's very important to us as citizens to observe elections, and that results in a lot of emotions around election. But you have to distinguish between the emotions that come from being a citizen partaking in an election to the emotions of investing. And when you look at the impact of elections on the market, most people wonder, and we'll talk today about, well, what impact is this election going to have on the market? Historically, what we've seen actually is that market performance is driven by other factors rather than election outcomes. It's really driven by corporate earnings, monetary policy, economic data. And so when we look at an election such as this week, it's really important for investors to distinguish the noise from what this means to us as individuals and what it means to us as investors.
Stefan, I would just to add on to what Richard just said, and putting the U.S. election in context, incumbents everywhere suffered this year. It's the biggest surge in global inflation in decades, and so you saw those in office really face the brunt of that. To get to Richard's point about economics and the impact that they have, it's the biggest election year in history. More than half of the world's population voted this year. We had new governments in Taiwan, in South Korea, the Netherlands, India, the European Union, the UK, of course, France, Japan, and now the United States. And so it's a reminder that economics usually have more of an impact on elections than the other way around. And stocks are off to a typical post-election start. You've got gains in the US markets, gains in global stocks that make up the MSCI All Country World Index here over the last couple of days. And that's despite changing parties and policies. In fact, the only two negative presidential transition periods, so from one presidential administration to the next, the only times we saw global stocks decline in that 54-day period from trading day period from election day to inauguration day was during recessionary bear markets. That was in 2000 to 2001 and 2008 to 2009. So that period of transition, markets were down. Other than that, they were always up, and it didn't matter who won. It's just that slight reduction in uncertainty getting through the election matters quite a bit, I think. And so we expect continued, although subdued, economic growth heading into 2025, similar to those transition periods that featured gains for stocks. Uh, the exceptions to the gains we've seen the last couple of days, we saw Chinese stocks yesterday slump a little bit, and those are German automakers slump. They came back a little bit today, but not fully. They're both likely to be a focus of any pressure on trade. Japan's election, I think, also may offer election lessons here for investors. Japanese stocks were up 3% in the 4 days that immediately followed that October 27th election. And that was despite a lot of headlines about the political uncertainty and the chaos given the defeat to the longtime ruling party there. And yet, and those that's accurate. There's more uncertainty there about policy going forward in Japan, but the immediate post-election reaction in stocks was a move higher. And even more importantly, perhaps, that PMI reading, the Purchasing Managers Index, my favorite. Like if I'm on a desert island, I can only get one piece of economic data. It's that Purchasing Managers Index from countries around the world. And the Japan PMI, which came at the preliminary reading, came in on October 24th, ahead of the election. That was 49.0. The final reading on November 1st was 49.2, slightly higher, suggesting even business sentiment rose after the election, despite the uncertainty. So I think that's something to look for here in the US as well. Maybe a little bit of a rebound in business optimism, but just confidence around their outlook, given less uncertainty around the election.
Jeff, now let's try to zoom out a little bit, and let's try to focus, as you've said, let's try not to focus too much on sentiment, but rather on these kind of key economic trends. So what key policy changes should investors be watching right now, after this election? When are they likely to take place, and how could these shifts shape the major sectors like tech, healthcare, and energy, for example?
So first, election trades are hard. I know we often feel like we need to make changes in our portfolio when there's a big political change, but let me give you an example. Shares of Maersk, the giant shipping company, plunged 9% yesterday on fears of a major hit to global trade from a potential Trump trade war. Those shares recovered all those losses today, like nothing happened. So it can be difficult placing these trades in a portfolio. Things may seem obvious, they reverse very quickly. Remember, after Trump's win in 2016, it was thought all those America First policies would cause emerging market stocks to suffer the most, while benefiting more domestically focused small cap value stocks. And small caps did outperform early on in Trump's 2016 presidency, but they were trounced over the whole term. They underperformed. The dollar rallied at the start of Trump's ascension in 2016, but promptly gave it all back and was lower over the 4 years. NEM equities, far from weakening, actually performed almost as well as small caps. And then when Biden was elected in 2020, the thought was the energy sector would be out. Traditional energy stocks would suffer given the push towards renewables, ESG, and discouragement of fracking. But as it happened, the Ukraine war boosted oil to become the best performing sector of Biden's term, aided by restraints on U.S. production. So the problem with politics is there's an extremely high noise to signal ratio. A lot is said, but that is a distant relationship to what's actually done. Announcements are frequently not followed through to the expected extent or magnitude. Now, Trump has made a strong point on tariffs and that the dollar should weaken. On those two issues, he may take action. Everything else remains to be seen. But even on tariffs, remember that despite threats of a trade war during the first Trump term, companies that had a high percentage of foreign sales performed similar to those that had zero foreign sales. So on average, there's not even a clear strategy from a sector perspective when it comes to a trade war.
Yeah, it's already difficult to forecast the economy. And I think that's what we've seen with, consensus forecasts for the last 2 years being consistently wrong. So it's a good reminder. Yeah, trying to forecast economic changes that follow US elections are extremely, extremely tricky. Yet I'm still going to ask you, on a global scale, what, how do you think those US policy changes will impact the different markets, the different regions, and potentially which sector or which region do you think stand to gain?
So the prospect of additional tariffs on the rest of the world in the second Trump administration does pose downside risks to economic growth and earnings growth, as well as upside risk to inflation. there have been a range of actions threatened, including broad-based 60% tariffs on all Chinese imports, 10 to 20% across the board on the world, excluding China, as well as 100% plus tariffs on cars assembled in Mexico, 200% on John Deere tractors assembled in Mexico, and 100% on countries that leave the dollar. Now, most analyses focus on that 60% tariff on China and a 10% tariff on the rest of the world. They've been repeated most frequently by Trump. Trump could push Congress to revoke that permanent normal trade relations with China and have more flexibility to implement these things. So what does this mean? Well, the IMF's latest World Economic Outlook, published 2 weeks ago, took a deep dive into the growth and inflation impacts of a potential trade war in 2025. And I've used some of the WTO's tools to try and simulate what this impact would be. And I came to similar conclusions. So in a trade war scenario that assumes permanent 10% US tariffs on all imports, plus full-scale retaliation by Europe and China, resulting in 10% tariffs on US exports, and also on all trade between China and the EU, the IMF projects that tariffs would result in a reduction of only 0.4% in US GDP growth next year, from 2.2 down to 1.8, nowhere near recession, along with negligible hits to Chinese and European growth and inflation, like maybe 0.1%. Now, when you account for a related increase in trade policy uncertainty that comes with an ad hoc approach to trade policy, the IMF found that the impact would be slightly larger, but not that material, nowhere near big enough to tip the US or the rest of the globe into a recession in 2025. And that might be important to keep in mind if some companies could be more impacted and they start, taking some headlines with some dire warnings. But let me say this, the IMF study did not include a 60% tariff on Chinese goods, nor a potential 20% tariff on all trading partners with full retaliation. That would look a bit different. That would mean maybe a 1.5 to 2% drag on US, Canada, and Mexico GDP. Those are the countries hit the most. Getting back to your question, who gets hit the most? The US, self-inflicted. Canada and Mexico have the greatest. 72% of Canadian exports go to the US, a similar percentage of Mexican exports. Big potential impact there. Now, in that worst case scenario, looking at like the UK might be a drag of about 0.3%. The EU may be a drag of 0.2. So relatively better economic growth outside North America. I think that worst case is unlikely. For one thing, Trump has relied heavily on support from Elon Musk, who's got a big bet on a Tesla gigafactory in Shanghai, and that presumably makes him an advocate of a more moderate approach to China and trade in general. And despite Trump's threats of across-the-board tariffs on China, he put together a phase 1 trade deal with China in his first administration, and the US, Mexico, Canada, the USMCA agreement. So there's the possibility that these threats are negotiation tools that could result in a grand bargain with China, called a Mar-a-Lago Accord, as well as other agreements with other countries. So we'll have to see what happens there. But I think the most likely outcome is a fairly mild one, as it has economic impacts and inflationary impacts relative to maybe some of the dire warnings in the headlines.
Thank you very much. So now I've kept the most difficult question for you, Richard, but that's the one that perhaps our audience will want a very a clear answer. If you're retail investors and you've got a 6 to 12 months horizon, what are the top investment ideas to consider right now?
Okay, I'm glad you used the word ideas rather than just what are the top investments. Okay, so I can't give you the names of any companies that we would recommend. But what I would say is, not all investors are the same. And if you say a 6 to 12 month time horizon, you have to incorporate the individuality of the investor, what their approach to risk is, and ultimately the why. And we always recommend this to investors. What is your intended outcome from this investment? What are you looking to achieve? And that could be a very, very different thing from one person to another. So 6 to 12 months could the time zone or the time scale might be the same between the two investors, but their approach to risk could be completely different, and what they're intending to use the money for can be completely different. If you look, for example, at an investor who's inherited some money unexpectedly and has decided they want to go invest it, or traveling in 12 months' time, and they want to just maximize their pot of surplus cash, that approach to investing would be very different to someone, for example, who is saving for a wedding, or saving for a house deposit. in 6 to 12 months' time. So that's the most important thing. I would always recommend and urge people to think about the why rather than the how. Okay. The second thing I would say is firstly, diversification. Diversification is key in all investing, regardless really of time horizon. Manage your risk, manage and protect yourself through diversification. And then also consider, when you talk about investment ideas, investment strategies. There are ways that you can manage and protect yourself through risk management, whether it's putting in trailing stops or conditional orders to protect your downside. Also, potentially option strategies. A lot of investors are sometimes a little wary of option strategies and think that they're something used by day traders. Not necessarily the case. A lot of people have very solid long-term investment strategies that are protected through simple options trades. So I would suggest when we talk about investment ideas, it's not necessarily about the sectors or the companies, but more about the why, and ultimately identifying what is this money for and how am I going to protect myself over this time period. 6 to 12 months in this example, it could be 6 to 12 years or 60 years. It's the same philosophy. Hope that helps.
Very sound advice. Thanks a lot, Richard. Maybe Jeff, in 30 seconds, any specific idea for the next 6 to 12 months?
Yeah, quick. So China may announce some additional stimulus here on the back of the Trump win. I think they were holding some dry powder. That could lead to another Chinese equity market rally. It could fade if they don't follow through with delivering a lot of that stimulus, but you could see another big pop in Chinese equities here, perhaps as soon as tomorrow. Second, U.S. financial stocks may benefit from a steepening yield curve. We're getting that, bond yields moving up on the spending outlook from a Trump administration. Solid credit environment, along with the potential for more favorable regulation. Remember, U.S. banks are holding 134 billion of surplus common tier one equity capital that could be released to shareholders if Trump upends the Basel III endgame proposal. Third, stubbornly high bond yields given the U.S. budget outlook could put downward pressure on U.S. price to earnings ratios. So as Richard said, having some exposure to countries with lower PE ratios and diversification does make some sense here.
Thank you so much. That was very, very short and to the point. Thanks for that. So now let's move on to the questions. So please, ask your questions in the Q&A box, but also vote for the questions you want to see answered first. So let's start with actually a great question. What is your take on potential changes to the Fed's independence, and what would be the impact on market?
Yeah, this is a really interesting and important question. And we internally are going through who we think the leading Fed candidates are. I mean, Powell will be unlikely to get another term, so we don't have an immediate change here, but there is probably a change coming. In the short term, given the budget outlook, the Fed is probably not going to cut as aggressively as you might have thought a few months ago as we look out through 2025. That said, it's really difficult to say how that sets up. There's some talk about eliminating the vice chair of supervision at the Fed, just as part of the deregulatory approach of the Trump administration. So a lot of potential changes there. There are no immediate candidates that jump out. There's been some jokes that have gone around. Kid Rock as Fed chair. I don't know. A lot of things going on, but not real clear who would take that role. And we've probably got a year or so to figure that out. But certainly the market would react dramatically depending on who that is, and any impact on the Fed's independence clearly could negatively affect the dollar.
That would make for some more entertaining Fed meetings, I guess. Okay, another great question. Can you see an impact on defense stocks?
Again, this is challenging to try and figure out. So on Ukraine, I think Trump will not be able to stop the war on day one on his own as Ukraine's funded into 2026 and seems likely to get quite a lot of U.S. weapons shipped before January 20th. They can fight on for quite some time yet if they choose to. So the longer term question is, what is the demand outlook if Trump wants to be a peacemaker? Does that negatively impact defense stocks? I think one of the ways we could see a deal cut is, Germany's uniquely exposed to U.S. tariffs given their auto export situation. So one of the ways they could deal with this is to offer Trump some sort of combined trade deal where they would essentially buy weapons from the U.S. needed in Ukraine to avoid, essentially becoming to a tariff deal with the U.S. and essentially funding the defense of Ukraine. So that could be a positive for U.S. defense companies if that's how that shapes up. Still very speculative at this point, but it's one of the ways in which Germany and Europe in general could try and cut a deal to avoid broader tariffs and continue the defense of Ukraine.
And now another sector-related question. What impact would you expect Trump's plan to have on microchips and AI stocks inside and outside the US?
So, the biggest challenge is how much of a sales impact does it have cutting off China even more completely than what we've seen so far? And we've heard mixed things. Some producers are talking about still robust demand, and there's still plenty of AI chip demand, but others are suffering. And so I think we are at an interesting point in the semiconductor chip cycle where it may be beginning to roll over. If you look at the Philadelphia Semiconductor Index, if you look at the semiconductor shipments, we're probably at the peak of the cycle. Maybe that doesn't apply to AI. Maybe that's just more memory and logic and analog chips. But I do think we could see a tougher environment for chips going forward, in part because of the cutoff of sales to a very big demand, very big customer, but also just the fact that we may be near a peak here in terms of the cycle for other types of chips, and all of that could begin to weigh on that sector, which is one that's got a pretty high PE at the moment.
I think one thing quickly just to add to that, which is interesting to me certainly, is Elon Musk. He's been quite vocal about AI and warned about AI, and he's going to be obviously, from the looks of it, a pretty important voice around the table in the White House. So just something to factor in is probably a good idea to pay attention to what Elon Musk says about AI if you're analyzing that particular sector.
And he has a lot of things to say. Okay, next, great question. Actually, I like that question. What are the biggest mistakes traders might make trying to take advantage of the post-election volatility?
Well, I think it's an example like I gave with Maersk at the beginning of the show. I mean, it seems like a quick knee-jerk reaction to say, oh, global trade might be hurt, so let me sell off the shippers. And of course, 9% drop. Everybody got that memo, and then a huge gain of literally gaining all of that back the next day. Tremendous amount of volatility around these trades. There's so many different factors. Something Richard said at the beginning of the call: economics have more of an impact on elections than elections do on economics. And so I think often we get that backwards, given how we're inundated with so much news about politics and elections. We tend to think they lead the rest. But in reality, the election was a consequence of the economics, right? And the inflation. And I think that's the important way to think of it going forward. I don't think the tariffs, again, it's early, but I don't think the tariffs are going to derail the growth outlook. The growth outlook is not robust next year, but it's positive. And when growth is positive, we generally see growth in earnings, and we generally see growth in stocks. And so I think the idea that, wow, it's so much chaos, I want to jump out of the market, or I want to jump into some of these stocks I think could benefit, or trade some of these, I think it's very early. And so I'm not saying you shouldn't do that with any portion of your portfolio, but think about allocating only a small portion of your portfolio to these types of trades, because they can get whipsawed very, very quickly, as we've just seen yesterday versus today in that very big move in the shippers. So, German automakers down a lot yesterday, rebounding today. Those kind of things. I think it's very, very, very compelling to try and make these trades. Also very risky.
What are your views on the possibility China retaliates on US tariffs by dumping US treasuries?
I think very low. China just doesn't own that many treasuries anymore. If you look back 10, 15 years ago, China owned 16% of outstanding US treasuries. They now own something like 3%. They just haven't bought any more over the last decade or so, and the Fed has in the US because of the QE programs. So China just doesn't really own that much. There's also not a good place to pour that money, right? So, they may be getting less in terms of dollars in the future. If these 60% tariffs come into play, they're going to be getting fewer dollars, so they will need to reinvest fewer and fewer of those in treasuries. But I think just of their own, I think there's very little reason for them to move that out. I think incrementally moving into gold, a few other places, but I don't see there's any more reason for them to do that, and I don't think the retaliation will be particularly effective.
Thanks, Jeff. We're getting so many questions. I'm trying to keep up. That's a great sign, people are very engaged. Would you consider increasing your allocation to alternative assets or safe haven investments like gold or real estate in anticipation of political and economic shifts?
I don't know. I don't know. I wouldn't, in the sense that I think the economic growth trajectory is still a positive one, and so you tend to find more safe haven. Gold tends to do better in either a really deep downturn or recession type environment, or a hyperinflationary environment. I think we are headed to inflation remaining fairly stubborn here in the US, but that doesn't necessarily compel a move towards gold. I would say that overall the backdrop is one of consistent growth, continued earnings growth. There might be a shift in leadership in the markets, but I wouldn't necessarily say one that's going to favor safe havens necessarily. We even think that in the bond market, you could add some high yield exposure here. Yields might be not falling like we thought they might have. Maybe yields in the U.S. might remain relatively stable, but along with that, maybe an environment that's more favorable towards corporations. I mentioned how there's tier one capital that could be released for financials. There's certainly the potential for lower tax rates. I mean, the Republicans take the House in addition to the Senate. There is a potential for extending those 2017 tax cuts in the U.S. and maybe even adding to them. That could unleash a little bit more there in terms of cash flow for shareholders. So I don't see this as a particularly negative backdrop. It's certainly one that's uncertain, but not one that necessarily would validate safe havens.
I think one thing to add to that, just in terms of safe havens for investors generally, if your portfolio is well diversified from an asset allocation point of view and you rebalance it regularly, there really shouldn't be a need to be attracted to safe haven assets. If you are disciplined, and that's probably the hardest thing for investors to be, but it is just about diversification across asset classes and then regularly rebalancing. And that's one of the things that a lot of investors, they either miss part one or part two, and that's how they make mistakes. And often then you're at risk of timing a play into safe havens or mistiming it and ending up back, a few steps back in your investment journey. So one thing just to consider there.
Okay, now another investment-specific question, and pardon my pronunciation. I never know how to pronounce this company name, but Berkshire Hathaway seems to be stockpiling cash right now. Maybe because they're concerned about capital gains increases, or why else?
Yeah, so you said it perfectly. Berkshire Hathaway has been sitting on a lot of cash lately. They've been allocating more to Japan recently. Look, this is a value-oriented manager, and the market has been all about growth for a long time. And so you're talking about some pretty high valuations for companies. High-quality companies are trading pretty expensively right now. It tends to like high-quality companies at low multiples. So this is not an environment that favors value managers. It may be becoming that way. I think banks look pretty good right now for reasons I mentioned, and so there might be an opportunity for him to allocate there. Japan has been a place where you've got PEs in line with their 10 or 20-year average, but you've got some growth opportunities there. So he's had to move outside of the U.S. to find some more investment opportunities, but certainly a reflection of his more value-oriented approach. There's certainly many growth managers that have no problem piling into this market, but that's what you'd expect from someone sticking to their investment philosophy in an environment with excessively high valuations. And I think in parts of the U.S. market, they are excessively high. He's not finding the same value he once did.
Thank you so much. And now a last question, because our Finimizers are asking for conviction. So if you could invest in one sector for the next 4 years, which one would it be based on Trump in office? Just one.
Wow. So, I mean, just one, it would be U.S. financials. That's our favorite sector, regardless of the outcome of the election. But remember, what I talked to you about in terms of releasing capital, talks of a steeper yield curve, a solid credit environment, and a backdrop of maybe improving loan demand over the course of the next year. Really like financials here, attractive valuations relative to the rest of the market, and it's a fairly substantial sector. So I think that's an attractive area, both in the U.S. and abroad. Financials are also the one that's coming up the highest on our quantitative rankings here at Schwab. We have a stock ranking model which has been around for a couple of decades, done a very good job, and the financials coming up top on that score as well. So both qualitatively, quantitatively, and in terms of the extent to which you can see the future, looks like the best sector to be in.
Financial as a sector and PMIs as an indicator are the two things you would need to take on a desert island, is the conclusion. Unfortunately, we don't have more time today, but thank you so much, Richard and Jeff. That was incredibly useful. Thank you so much for all the insight. Finimizers, don't forget our biggest event of the year. It's very, very fast approaching, and you can register your tickets. Of course, I'm talking about the Modern Investor Summit, which will be a 2-day event on December 3rd and 4th, and it's going to be packed with back-to-back sessions and workshops led by the biggest names in finance. And that's going to be the perfect opportunity to elevate your investment knowledge and network with fellow retail investors. So, just register for free for your ticket using the link shared in the chat. It should appear now. And finally, as you leave the event today, a pop-up survey will appear on your screen. Please just take a few minutes to let us know what topics you're interested in hearing about at future events. Once again, thank you so much for joining us. Thank you, Jeff. Thank you, Richard. Thanks, all Finimizers, and hopefully see you soon. Have a nice day, all.